Welcome back. Here's a question worth asking right now. If gold is supposed to be one of the world's most reliable safe haven assets, why has it just touched its lowest level this month? And why is today's recovery struggling to hold any conviction? Today is Friday, 17th of July, 2026, and gold is doing something that tells us a great deal about where global financial conditions currently stand. After sliding to a monthly low, the precious metal is clawing back some ground, but that move higher is fragile at best. The two forces pressing down are the U.S. Federal Reserve's increasingly hawkish tone and a U.S. dollar that simply refuses to weaken. Together, these two headwinds are placing a firm ceiling on any gold rally, and understanding them is essential if you want to make sense of where the gold price goes from here. Over the next few minutes, we are going to walk through exactly what happened, why it matters, and what you should be watching if you hold gold or are considering it. So, how did we get here? Gold's slide to a monthly low was not a sudden shock, it was a gradual erosion driven by shifting expectations around U.S. interest rates. When investors start pricing in the possibility that the Federal Reserve will keep rates higher for longer, or even raise them further, gold loses one of its most powerful selling points. The opportunity cost of holding a non-yielding asset rises sharply. Put simply, if a U.S. Treasury bond is offering a meaningfully high rate of return, investors have considerably less reason to park their capital in gold, which pays nothing. That is the fundamental economic mechanism at work here. On top of that, global risk sentiment has been relatively steady in recent weeks, removing some of the acute safe haven demand that would normally provide a floor under prices. The combination of rising opportunity cost and fading safe haven flows produced a steady drift lower until buyers stepped in cautiously today to halt the decline. Let us talk about the Federal Reserve in detail, because this is the single most important driver in today's gold market. The Fed's hawkish outlook, meaning its strong preference to keep interest rates elevated, or to raise them further if inflation requires it, has been weighing heavily on precious metals. When the Fed signals that it is not finished fighting inflation, it effectively tells markets that the dollar will stay strong and that borrowing costs will remain high. Both of those outcomes are negative for gold. Crucially, rate hike bets have been building in markets, meaning traders are actively positioning for the possibility of another Fed move before the year is out. Every time that expectation strengthens, gold comes under renewed pressure. The central bank's language around inflation, labor market resilience, and economic data all feed directly into gold's price discovery. Today's modest recovery suggests some of that hawkish expectation may already be baked into the market, but by no means all of it. The second major headwind for gold is the US dollar, and the relationship here is both straightforward and critical to understand fully. Gold is priced globally in US dollars, which means that when the dollar strengthens, gold automatically becomes more expensive for international buyers, and global demand falls accordingly. A firm dollar, underpinned by the Fed's hawkish stance and the relative strength of the U.S. economy compared with many of its peers, has been acting as a persistent ceiling on gold throughout this period. When buyers in Asia, the Middle East, or Europe look at gold today, they face an additional price premium created purely by the currency exchange rate dynamic. That suppresses demand and limits how far the metal can rally, even when other conditions might be broadly supportive. Today, the dollar index remains elevated, and until we see a meaningful and sustained softening there, gold faces persistent resistance on every attempt to push convincingly higher. So what does all of this mean for people who actually hold gold or are considering entering the market right now, on the 17th of July, 2026? For long-term investors, today's dip to a monthly low and the subsequent partial recovery is a familiar pattern. Gold often finds its footing after a sell-off when the broader macro picture remains genuinely uncertain. The critical question is whether today's recovery carries real momentum, or whether it is simply a technical bounce before another leg lower. For short-term traders, the environment is more challenging. A market that recovers from a low but faces clear overhead resistance from dollar strength and hawkish Fed rhetoric is not an easy setup from the long side. Risk-reward ratios are compressed and stop-loss levels are tight. Meanwhile, for institutional buyers and central banks, which think in years rather than weeks, any dip to a monthly low is historically viewed as a potential accumulation opportunity, and that underlying demand provides a meaningful degree of support. It is worth briefly placing gold within its broader context, because the entire precious metals complex is moving under the same set of macroeconomic forces. Silver, in particular, has been tracking gold's directional moves this year, though with considerably greater volatility given the smaller size of that market. Silver's outlook for the remainder of 2026 is shaped by both its monetary properties, which it shares with gold, and its industrial demand, which is growing thanks to the global green energy transition and the continued expansion of electronics manufacturing. That dual demand profile means silver can sometimes decouple from gold in ways that create trading opportunities. For now, though, both metals share the same fundamental adversary, a Federal Reserve that has not yet convincingly signaled a pivot toward rate cuts. Until that signal arrives clearly and credibly, the ceiling on precious metals broadly will remain in place, and today's partial recovery in gold should be understood within that wider context. Looking ahead from today, Friday 17th of July, 2026, the near-term outlook for gold is cautiously constructive in a limited sense, but remains firmly capped by prevailing macro conditions. The recovery from the monthly low does signal genuine buying interest at lower price levels, and that demand floor is meaningful for the near-term picture. However, unless we see a genuine shift in the Federal Reserve's tone, perhaps triggered by weaker-than-expected U.S. economic data on inflation or employment, the headwinds from the dollar and rate expectations are unlikely to dissipate quickly. Upcoming remarks from Fed officials will be closely scrutinized by the gold market. A softer inflation or jobs reading could give gold the catalyst it needs to extend today's recovery into something more sustained. Conversely, strong data would likely renew dollar strength and push gold back toward its recent lows. At this point in time, the balance of risks leans modestly to the downside for the near term. Here is today's essential takeaway: gold has recovered from its monthly low on 17th of July, 2026, and that is a constructive technical signal worth noting. But the two structural forces suppressing sustained gains, a hawkish Federal Reserve and a firm US dollar, remain very much intact. Until one of those changes materially, gold is likely to continue trading in a choppy, range-bound fashion, recovering when bearish sentiment runs too far, and fading when the dollar reasserts itself. For long-term investors, patience remains the correct posture. The fundamental case for gold, as a hedge against inflation, currency debasement, and geopolitical uncertainty, has not been undermined by today's action. It has simply been deferred. Watch the Fed, watch the dollar, and watch the data. Those three things will tell you everything you need to know about gold's next significant move. If you found this analysis useful, please give this video a like, share it with someone who follows the gold market, and subscribe to this channel for daily precious metals and global financial market coverage.